听见资本本期视频为您带来的是摩根大通在4月4日录制的关于美国新关税政策对全球外汇市场影响的观点。最近市场经历了一场真正的风暴，突如其来的大规模关税政策让全球都捏了一把汗。这不仅仅是普通的市场波动，股票抛售，信贷紧张，连美元都跟着剧烈震荡。这期内容你会听到专家深入分析，为什么这次关税冲击可能根本性地改变了游戏规则。他们警告，美国的经济衰退风险正在急剧上升，这对你的投资意味着什么？美元曾经的避风港地位可能正在动摇，因为它自身的资产吸引力正在被侵蚀，实际回报率优势不在。哪些货币在这种环境下可能成为赢家，哪些又是输家？日元和瑞郎这样的传统避险货币被看好，但像澳元、斯堪的纳维亚货币这些曾经受挫的中等收益货币又将何去何从？更关键的是，新兴市场可能要皱眉头了。即使美元不像以前那么强势，但全球贸易放缓和风险规避情绪对依赖出口的新兴经济体来说可能是双重打击，特别是亚洲市场受关税影响首当其冲。虽然这次可能不会引发像过去那样的大规模危机，因为市场失衡没那么严重，但风险依然不容小觑。最让人警惕的是，专家认为这可能不是短期问题，市场似乎已经认定这是一个结构性的转变，不确定性将长期存在，甚至连美国的近邻加拿大和墨西哥虽然暂时得到豁免，也已经感受到了深刻的可能需要数年才能调整的冲击。接下来是英文录音的全部内容，如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hi, and welcome to this JP Morgan at Any Rate podcast, where we're going to discuss the outlook for G10 and EM currencies in what's been a pretty volatile week. I'm Saad Siddiqui in the Emerging Market Strategy team. I'm joined by Meera Chandan, who is co-head of FX strategy at JP Morgan, and Pat Locke, who is an FX strategist. So let's get straight into it, Meera. We've had what seems to be a watershed week with the announcements of the Liberation Day tariffs. That's caused a lot of market consternation. We're seeing equity sell off. We're seeing credit spreads rise. The dollar also has been quite volatile. Against that backdrop, comments today from Fed Chair Powell seems to have implicitly pushed back on expectations for imminent front-loaded monetary easing. So how's your view here on the broad dollar evolving on the back of the tariff announcements that were much higher than expected, plus also some of the comments we've seen from Chair Powell today?
Sure, absolutely. Thanks, Saad. Yes, it has indeed been a historic week. I think what was really quite astounding in the delivery of tariffs was, firstly, how broad-based they were in nature, and secondly, how large the size was to begin with. In some ways, it's good to know that this is almost the near worst-case outcome on tariffs, so it's sort of good to know and have that up front. But the problem here, of course, is that the extent, the magnitude, and the scope of tariffs have been enough to really, to adversely affect business confidence, market confidence quite acutely, and it's raised recession probabilities everywhere. I think we can agree that the tariffs of the scale are going to have a growth impact adversely everywhere, U.S. included. It's going to have an inflationary impact within the U.S. as well. And of course, it's driven up the recession probabilities. It's on markets' minds, it's on our minds as well. And of course, while the focus is going to be very much on how the negotiations evolve from here, if any, and how the countermeasures evolve from here, the problem is that from a market standpoint, to a large extent, the damage is already done and the markets are moving to price in a recession. Now, what does this all mean for the dollar? I think there are two aspects to this. The first is the relative attractiveness of U.S. assets, and second is the safe haven bid for the dollar, which usually affects the high beta currencies. Now, the relative attractiveness of the U.S. Assets, I think, is a very important and germane issue for us. I think the way to think about this really is that first and foremost, what this tariff package has done is it's eroding U.S. real yields. And that is a problem for the dollar because it's been a source of support so far for the last couple of years for the dollar. one thing, and the reason we're getting this adverse impact is because even though the growth impact is negative globally, including the US, I think the inflation impact is actually quite differentiated. So you have a situation where growth is going down in the US, but actually inflation expectations, or at least the forecast for inflations, are going to be going up. We were looking for core inflation to be north of 3% in 2025 before this tariff announcement, and that's only going to go higher from here. So this puts the U.S. in a very awkward situation. Firstly, it raises recession odds, but also it lowers the overall level of real yields because inflation is just going to be stronger, and it takes away one source of support for the dollar. It means the dollar is catching down to the rest of the world in terms of real yields. Whereas if we did the same analysis on real yields maybe a month ago or even a quarter ago, the dollar would have yielded well above 50% of the currencies universally. So I think that real yield support erosion is important. And then, that argues obviously for a weaker dollar. And then the second is that, recession odds are going up, risky markets and risky assets are going to be under pressure. Where are risky assets the most crowded? Well, the world is long of U.S. assets, U.S. equities in particular. And if these recession probabilities need to be priced in, then that needs to be unwound. So that's clearly a problem for risky assets, but the U.S. in particular, because a lot of this buying came from foreign investors as well. And we've been talking about various currencies that could benefit from such a rebalancing, whether that's the Scandinavia, whether that's Eurozone, and so on and so forth. So in a nutshell, there are certain elements of this outcome which are very dollar bearish. And there are certain currencies that benefit from this lower yield impact. But of course, if we're entering into recessionary territory, there are going to be certain candidates that are going to be under a lot of pressure as markets move to price in a recession risk.
Thanks. So I'd like to ask you a bit more about those different candidates that you've just mentioned. So which currencies do you think specifically are winners and losers in this environment? What does your framework say about distinguishing between, the more safe haven currencies, the yen and the Swiss francs versus the higher beta, more growth leveraged currencies? Will they still benefit if the dollar is now more of a kind of a riskier asset than it's been in the past?
Yeah, I think it's a fair question, and it kind of comes back to this issue of does this dollar smile still exist? We absolutely think it still exists. It's just, that safe haven dollar bid that you get is going to be against a fewer subset of currencies because dollar assets are so widely held. And if I would break it down, I would probably say there are three tiers of currencies. One is the absolute low yielders like the Japanese yen or the Swiss franc, which are your typical safe havens. There is the second tier, which is the mid-yielding cyclical currencies, which got beat up a lot in the last couple of years because they were yielding less than the dollar. That's a lot of Asian currencies. It's a lot of course, in G10, it's the Australian dollar, the Scandies. And then you have the other spectrum, of course, which includes the absolute high yielders. Within DM, that included sterling and the US dollar, but of course, within EM, it included LATAM. And I would say that pricing in of US recession risks is probably the most beneficiary to your absolute low yielding safe haven currencies, which is your Japanese yen and your Swiss franc. And between those two, our preference has been for the yen for the simple reason that valuations are actually quite, still quite cheap if I look at longer term metrics. Swiss franc also should benefit, the dollar should weaken, but, to probably a smaller extent, simply because the starting valuation is not as attractive. The mid-yielders like Scandies and the Australian dollar are already quite cheap. On average, they weaken 10% in a recession. They've already done that in the last couple of years. Doesn't mean there's not a lot more they can do if a recession gets priced in. But I think valuations eventually, once the dust settles, should give them some support. And then there is the much higher yielding, currencies, which I guess comes into your space, which I think are going to be more adversely affected as the market moves to price in a U.S. recession, and particularly in areas where there is even greater U.S. Economy linkages. So that's the spectrum of how we're thinking about it. Now, in terms of our own strategy, we've been talking about U.S. moderation for a while now. What we didn't have a good handle on is really where are we going to land up? Is this going to be U.S. moderating to trend growth, or is it going to be U.S. Moderating and sliding all the way down to a recession? And I think we've generally speaking liked cheap candidates that would benefit in both those regimes. So Scandis has been a preferred one for us in sort of the moderating regime. The Japanese yen in case of a defensive one. And I think it's fair to say that given this recent evolution, we are kind of sliding in that scale more towards the defensive side and more the recessionary side. So Japanese yen is probably one of our favored currencies at the moment, both versus the dollar as well as on a cross-yen basis, say versus the likes of the growth-sensitive currencies like Kiwi or even Euro, for example. But overall, I think euro-dollar itself can actually benefit from this dynamic. Euro-dollar could still see some strength ahead of us, predominantly because real yields for the first time are moving in favor of the euro. And also there's this U.S. equity rebalancing story, which does benefit the euro to some extent. So let me stop there, Saad, and turn it to you and turn it to EM, because I've spoken quite a bit about the dollar. But this week, you've expressed a more bearish concerns on EMFX. Why is that happening now, and how bad can this environment really get for EMs?
So thanks, Mira. I think for EM, the way I would characterize it is that even if the dollar smile might not be as strong or as acute than it was in the past, I think EM currencies will still be frowning. And I think it's partly to do with the fact that, EM currencies are either being hit, pretty strongly by these tariffs. And I think that's really impacting sentiment. It's impacting expectations, CapEx. For example, we're already expecting Mexico to be in a recession with GDP contracting this year, despite the fact that you haven't had necessarily substantive tariffs being imposed, but just the uncertainty is quite significant. I think it's the same case in EM Asian currencies that are leveraged to global trade. So if global trade is going to get hit, emerging markets growth is going to get hit. And especially if that's happening in an environment where there is broader risk aversion, that we're seeing the types of weakness in U.S. equity markets and credit spreads rising. I think a traditional U.S. recession playbook still makes sense in emerging markets, FX. Now, there are some differentiating factors for EM on the whole as a starting point coming into this period. For one, I'd say that, typically when the U.S. enters a recession, it's come after a long period of, capital flows coming into emerging markets. You get a big overhang of carry trades, and big imbalances are built in the process. And the unwind of those imbalances can often lead to crises in EM. That's been the rule of thumb and the framework that's worked in the past. The differentiating factor this time around is related to what you mentioned, that the U.S. was the beneficiary of large capital inflows, not emerging markets, through this period of expansion. So generally, with only maybe a couple of exceptions in some select frontier type of markets, you don't have a big overhang of carry trades. You don't have big imbalances that have been built either via large and persistent current accounts. You don't have major currency valuation problems either. I mean, typically most EMs right now are, not too far from fair value. And even the expensive ones aren't looking overly expensive. So I think these are mitigating factors. They're not going to stop EM currencies from broadly weakening. In the past, we might have preferred to be long the dollar against the high beta EM currencies. I think in this environment, to take from your framework, maybe it's just better off being long Swiss and yen as kind of safe haven currencies to be long against the shorts and underweight positions in EM currencies. So that's the general position and the stance that we have. like I said, there's some mitigating factors, so we're not expecting the types of really big, outsized, acute crises that might have been expected in the past going into a U.S. recession. But overall, I think there is a good case to be made for a traditional EM playbook into a U.S. recession to be kind of dusted off.
Thanks, Saad. And let's talk about a bit more of who the relative winners and losers are. There was clearly a regional differentiation on tariff policy. To what extent does that matter for performance of EM currencies?
So you're right to point out that if you look at the tariffs that were imposed, I mean, just the way that the formula was constructed, it seems, from what we understand about how the tariffs were constructed, it's those markets that have a greater, trade deficit or trade surplus with the U.S. Are the ones that are being hit more. So almost by construction, the more leveraged the market is to trade with the U.S., the harder it's getting hit. And that means EM Asia is facing the brunt of the tariffs. You get a little bit in Europe as well. And Latin America, partly because it's also exporting commodities and there were various exemptions for commodities, seems to have been let off the hook, relatively speaking. So I think that we should expect the growth outcomes to be probably worse in those markets that have a greater trade exposure to the U.S. So that means EM Asia. These are also central banks that are going to have to be cutting rates, and so their carry is going to come down further, and therefore we expect a lot of the impact of tariffs to be concentrated there. Having said that, if we are going into a traditional U.S. recession or recessionary type of environment, then I think the fact that Latin American currencies haven't been directly impacted by the tariffs is only going to be, I think, a small mitigating factor. Especially if commodities prices are going to fall significantly and you get a big terms of trade shock as well. Those are high beta currencies. They're also going to weaken. So we try to have a little bit of a relative value tilt in our recommendations, so to have more of our bearish positions concentrated in EM Asia and a bit less so in Latin America. But I think the big beta move of, higher beta currencies weakening more is still probably going to hold. And that's what I would emphasize over any regional differentiation at this point. But, we've talked a lot about so far, the impact of these tariffs, how they've been higher and kind of and broader than expected. And the market now seems to be, taking those as being part of the kind of a new market regime. But Pat, I wanted to ask you on these tariffs, do you think that the market is over extrapolating what's just happened this week? There's clearly scope for negotiation, and are we underestimating the ability for things to turn around?
Hey, thanks, Saad. Look, I understand the market's kind of like implicit desire to want to see things turn around. Certainly we've kind of had a whiff of that today with the Vietnam news, for example, suggesting that they might cut their tariffs down to zero. And I think stepping back, I think the bigger issue is that we've had something of a sea change or watershed or Rubicon moment already. In fact, twice by levying 25% tariffs on Canada and Mexico, only to walk them back each time. So the market, I think, is ultimately going to continue to absolutely guarantee 100% that these things are not going to ultimately be repaired, right? So I think that is going to just be, unfortunately, ingrained in market psychology going forward, and they're going to be very sensitive to similar kind of news releases to this Vietnam stuff generally. But at the end of the day, you look at the price action, and broadly speaking, that little post-Vietnam relief rally in markets was very short-lived. And I think that does generally kind of, answer the question of what you're alluding to, is that market still does ultimately deem this to be a real kind of like structural shift in global trade. Mira mentioned kind of like, the global recessionary odds kind of going up here. I think that's obviously significant. And in fact, I think it's so wide reaching, both in scope in terms of breadth, that even if there were to be some partial walkbacks, I think, the administration has shown its hand that it does want kind of more fundamental change, and that ultimately that is going to be, is going to force behavioral changes across different actors in the global economy. Just because I think the level of uncertainty has risen so high, and kind of those, the things that we're taking for granted, generally speaking, unfettered access to U.S. markets, I think can no longer be taken for granted. So again, I think that requires behavioral change. And, for that reason, it's not surprising really to see kind of, risk markets under duress into the close of the week this week.
Thanks, Pat. I'd like to just ask a follow-up on, you mentioned Mexico, Canada, USMCA, the fact that we didn't get news yesterday or day before yesterday on kind of Canada and Mexico. The market took that as a bit of a positive signal, at least, Mexican assets initially were cheering that. But, medium term, do you think it is still right to expect some type of USMCA carve out or preferential treatment given the economic integration between the US, Canada, and Mexico, or does it even really matter at this stage? Is it too far down the line to expect that?
Right. So I guess there's technically two questions in there. One is, whether USMCA carve-outs can persist, and to your second point, whether it matters. I mean, I think clearly it was important that Mexico and Canada were both carved out this week. Obviously, we know that the USMCA renegotiation process is going to be brought forward, and in general, maybe that will kind of protect these two economies from the more kind of like punitive levels of baseline and reciprocal tariffs, being applied elsewhere. I think, that certainly does matter. But I think more importantly, to the second part of your question, I maintain that a lot of damage has been done, again, to the kind of the psychology of the economic actors in both Canada and Mexico. I talk about, scarring, for example, in Canada. I think it was very interesting to hear Mark Carney speaking last week, and basically saying that Canada must fundamentally reimagine its own economy now. Right, that's obviously quite a striking statement, and he followed that up as that we must dramatically reduce reliance on the U.S. And so I think even if USMCA economies are carved out of the broader tariff plan, even if the USMCA is renegotiated, I think there's been significant damage delivered by the policies so far year to date for each of these two. And I think that's going to take like a long kind of period to adjust, and it's probably not going to be painless. And in the meantime, I think, the cyclicals are not particularly optimistic. Canadian PMIs, for example, have absolutely cratered these last couple of months. And we got the most significant payrolls contraction today in Canada in the last 3 years. So it's having very kind of real cyclical effects. And the medium-term structural issues, I think, are going to be there. It's kind of like a permanent uncertainty factor that has to be baked into these economies going forward. And so I think bottom line is that, yes, even if there is certain USMCA exemptions, it's hard to say that the coast is absolutely clear for either Canada or Mexico on a long-term basis.
Well, thank you, Pat, and thank you to Mira as well. I think we'll wrap up there. There certainly seems to be a broad consensus that we have entered a new regime this week. And I think, we'll probably have a lot more to talk about in the coming weeks about how this environment evolves. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025 JP Morgan Chase & Company, all rights reserved. This episode was recorded on April 4th, 2025.